Hi, everybody.
Hey,
What's going on? Can you hear me?
yes, we can.
I can hear you.
How was your weekend?
Pretty
It's
good.
good. Below average.
Anybody get arrested?
Brendan O'Kane did. Public intoxication.
Rock on, dude. Our hero for today, Brendan O'Kane.
Oh, baby.
Who? Anybody go to that party everybody got in trouble for?
Yeah, Brendan was the one throwing it.
Where was it?
His bedroom.
Oh, that reminds me. I got to go through and look at everybody's picture and make sure nobody's still in bed. Everybody get out of bed. You're in school today. You're in school now. Holy shit, somebody's in the library. All right. Hey, did you see that I put up on Moodle a place to upload your case studies? So today we'll start chapter 9. Chapter 9, Banking and the Management of Financial Institutions. This chapter, how do banks make money? Although we talk primarily about commercial banks, the principles apply to other financial intermediaries as well. We're going to look at a bank's balance sheet. Then we're going to apply changes to the bank's balance sheet using T accounts. Then we're going to identify ways in which banks manage their assets and liabilities to maximize their profits. Then list the ways in which banks deal with their credit risks. And then we'll talk about gap and duration analysis and identify interest rate risk. Do you guys do that in any other classes, gap and duration analysis?
Yeah, a few classes.
What?
Yeah, a few classes.
Where?
Accounting, and we do that in finance.
Oh, yeah? Okay, so Dejor is going to lead that section of the lecture. I'm kidding, dude.
Yeah, I know. I didn't know.
All right, the balance sheet. Oh, shit, I got to share again. Let's start looking at assets and liabilities. So when we look at the balance sheet of a bank, like any balance sheet that you would learn in accounting, assets must equal the combination of total liabilities and capital. So liabilities, like checkable deposits, non-transaction deposits, borrowings, and bank capital. So liabilities and capital are sources of funds for a bank. Yeah. So if you go to the bank with grandma's check for graduating and deposit it, that becomes a liability of the bank, doesn't it? Because they have to give it back to you at any time, right? On the other side of the balance sheet, so liabilities and capital are on the right side of the balance sheet. On the left side of the balance sheet are the bank assets. So the bank assets would be securities that the bank owns and loans that the bank has made, right? A loan that the bank makes, that's an asset of the bank. Yeah, that's generating income for the bank. Assets, we say reserves. Cash in the process of being collected. Deposits at accounts at other banks. Securities that the bank buys for their own investment portfolio. Loans that they make, and other assets. Let's go through each one of these. Reserves. This is a product of the required reserve ratio. The Federal Reserve sets a required reserve ratio. You guys ever hear of that? The Federal Reserve's required reserve ratio? Go ahead, Cole, tell us what we're talking about.
Well, isn't it just the reserve that the federal bank makes? Like, don't they set a rate and then all the rest of the banks follow it?
Well, the reserve ratio is a rate, yeah. What's it all about, though?
I don't know. I don't know.
Somebody help him out here.
You could earn low interest rates. Reserves.
Well, they do earn interest rates on reserves now. They didn't in the past, but now they do. Noah, my arch enemy.
I'm not sure. Sorry.
Let me just make sure everybody on the other page is not in bed. Brooke is in the library. She can't talk, right? Because she's in the library. Ah, Michael Mandola.
Yeah.
What do you think?
Isn't it just so that like the banks don't go back into debt? Or I don't want to say like that, but so they don't end up going bankrupt and stuff like they did in like the housing crisis.
Yeah, well, that's a good point, and we're going to talk about that housing crisis and the banking industry, but it's not quite what I'm looking for. What I'm looking for here. Oh, hey, Bobby, why don't you tell us? Oh, you're in the library. You're in the library. Okay, you can't talk. All right, listen, everybody. Bobby sent me a chat, and it's absolutely correct. It says that what banks must hold on to. So if you go to a bank and you deposit $100 that grandma gave you for graduating Bonaventure, the bank has to hang on to some of that money. Those are required reserves. It's a rate that's set by the federal government, the Federal Reserve. They say, oh, of that $100 you just got from Bobby in a deposit, you have to hang on to 10% of it, just in case, we have some banking issues or problems. So the required reserve ratio creates this reserve requirement. Yeah. Now, banks could hold more than that, and we call that excess reserves. Yeah. So that's reserves. That's number one on the asset side of the balance sheet. Cash items in process of collection. So maybe this is you go to the bank with a check written by Bonaventure University as payment for working at the library. Yeah, the bank hasn't actually have the money yet from Bonaventure's bank, but they're going to get it. Yeah, deposits at other banks. We call this correspondent banking. Very often this is used to facilitate business in smaller banks. Securities. These are investments made by the bank to earn income. Yeah. But it cannot be equities. Maybe bonds, maybe municipals. Yeah. Loans. Loans is usually the primary source of income for a bank. 53% of assets are in the form of loans. These are usually considered illiquid. Other assets, what might other assets be? The building, yeah? Something like that, physical property. So here's a balance sheet of all commercial banks' items as a percentage of the total. So we have reserves, security, government and agency investments, state and local government and other securities. Then I'm going to go to the next page because they have these loans, commercial loans, real estate loans, consumer loans. So commercial and industrial loans, this would be a line of credit for Dresser Rand, maybe. Yeah. Real estate, this is going to be mortgages for all the houses in Allegheny. Consumer, this is credit card debt. Interbank, this is loans to other banks. Other, I don't know what other is. Loans for other purposes, right? Other assets that they may have under their asset side of the balance sheet, the building, yeah? So we got to go back now to the previous page and look at liabilities. Checkable deposits. This is the money that you go to the bank to deposit, right? Non-transaction deposits. So checkable deposits, that's money in the bank, but you could write a check and then that money has to come out of the bank, yeah? Well, you could also have a savings deposit. So there's no transaction on that. You just go and you put your money in, and then when you want it, you go and you take it out, right? Savings deposits, small denomination time deposits, large denomination time deposits. This would be like CDs, borrowings, bank capital. Capital is the owner's equity. Okay. So basic banking, this is how it works. You go and you open up a checking account and you put in $100. The bank says, oh, I got checkable deposits of $100. It goes into the vault as cash, right? Opening a checking account leads to an increase in bank's reserves equal to the increase in checkable deposits. So the bank could also say then that they have reserves of $100 because they haven't done anything with that money that you brought there. Yeah. And their liability still is the same, checkable deposits. That's a liability of the bank to you because you went and deposited it. So we have the First National Bank. That's what we're talking about here, right? First National Bank. What a great name for a bank. Assets and liabilities. Cash. So if you wrote a check from Second National Bank to deposit that money in your new account at First National Bank. First National Bank would record that as an asset, which is cash items in the process of collection. So they're waiting for the money to actually come from Second National Bank. And they would say they have a liability of $100. Then we would say First National Bank would, of course, say their reserves have increased by $100. Their liabilities are the same, $100. Second National Bank says, oh, Sarah here wrote a check to First National Bank. So our reserves are being reduced by $100 and our checkable deposits are being reduced by $100. Yeah. Now, how does a bank make a profit? So the bank says, hey, we just got $100 from Sarah. What should we do? Well, as we just said, they were required to keep a certain percentage of it. But the other part of it, they could either keep as excess or they could make a loan and charge interest on the loan. Yeah. So, oh, sorry, I hit the wrong button. This is stuff that you study in, usually you study this in macro, yeah, the money multiplier. They make a loan of $90 and somebody borrows that $90 and they go and they buy something, right? Or the person who sold the thing then takes the $90 and goes to their bank, and their bank is required to keep 10%, but then they loan out the other $81, right? And the person who borrowed the $81 takes it and goes and buys something. And the person who gets the $81 goes and brings it to the bank. And the bank is required to keep $8.10, but they loan out the other 70 some odd dollars. This is where the money multiplier comes from in macroeconomics, yeah? So we have four primary concerns. These four things are the primary concern. Oh, sorry. These four things are the primary concerns of banks: liquidity management, asset management, liability management, and capital adequacy management. And they must be concerned with these two things in order to be concerned about these four things. Okay, credit risk and the interest rate risk. So these are the four primary things that a bank has to actually do to be successful. So let's do this. Liquidity management and the role of reserves in liquidity management. So suppose a bank's required reserves are 10%. They have deposits of $100 million. They have reserves of $20 million. Should they have more or less than $20 million?
Less.
Yeah. They said that. Who said that?
Me,
Who's me?
Jake.
Well, you're not lighting up yellow like you should. Anyway, what was I talking about? Oh, so they have $20 million in reserves. How much should they have? Required reserve ratio is 10%. Madison,
Whatever 20% is of the 20 million. Or the,
Yeah,
sorry, the 10
so-
20 million.
no, they have 100 million in deposits and the required reserve ratio is 10%. So they should have 10% of the 100 million or $10 million. Yeah, 10%. So thank you very much. So they don't have that. They have $20 million. Why would they do that? Why would you do that? You're managing a bank. You're going to graduate from Bonaventure and get a job managing a bank. You got $100 million in deposits and the required reserve ratio is 10%, and you're keeping 20. What's up with that, man? Why are you doing that?
The Fed pays interest rates on excess reserves.
Well, yes, they do, but do you think the Fed pays an interest rate that's equivalent to what you could get if you took that money and made a loan or an investment? Probably not. Right? Yeah, they pay a little bit on your excess reserves, but you could take that money and invest in it or make a loan to the new bicycle manufacturer in town and make more money. Why wouldn't you do that? Why would you want to have extra reserves?
Maybe you fear there's going to be a bank panic and kind of like in '08 with the mortgage housing crisis.
Yeah, yeah. You're looking at the economy and you're saying, oh my God, the president's in the hospital and the world is going to hell in a handbasket. And I'm going to keep extra money held back here because I don't trust the things going forward. So you're being extra cautious is what it boils down to. So this dude has $20 million in reserves. They make $80 million in loans and they have $10 million out in securities like municipal bonds or whatever. And the owner of the bank has $10 million in capital. This bank has only $90 million in deposits. They should have had $9 million in reserves. They only have $1 million in extra reserve. They make $80 million in loans and they have $10 million in securities. And the owner of the bank has $10 million in capital. So go back here. If a bank has ample excess, a deposit outflow does not necessitate changes in other parts of its balance sheet. That means that if I was a depositor at this bank on this side on the left and I wanted a new yacht, I could go and withdraw $10 million. And that would leave them with 90 and $10 million in reserves. So they'd be styling, right? They wouldn't even have to blink an eye. But if I was a depositor at this bank and I wanted a new yacht and I went and I borrowed and I withdrew $10 million, that would wipe them out, right? They would then have $80 million in deposits. They would have to go find $8 million. Yeah. Reserves are a legal requirement and shortfall must be eliminated. So this dude, I just gave me $10 million. They have no reserves. This dude just gave me $10 million. They have $10 million in reserves. Okay. Excess reserves are an insurance against the cost associated with deposit outflows. This dude has got to go find that $9 million. And they're going to have to pay to do it. they have 4 options to cover this shortfall. This is a shortfall. These people have 4 choices. They could borrow $9 million. So they here, we have borrowing $9 million to get their reserves up to 10%. The cost is the interest rate paid on the borrowed money. They're going to have to pay interest on it, of course. They could sell securities. Yeah, they had securities. Let's go back a page. They had $10 million in securities. So they sell $9 million in securities to get their reserves up. So far we said they could borrow the money, right? Generally from other banks. They could borrow from the Fed, but now they're talking about selling securities. What's wrong with that idea? Brooklyn?
I'm not entirely sure. Could you ask the question again, please?
The bank, their second choice of covering the required reserve shortfall is to sell some of their securities. But maybe that's not a good idea. Why might it not be a good idea?
Yeah, I'm not sure. I'm sorry.
David?
I'm not really sure either.
Well, if they sell securities, it might not be a very good time to sell those securities, right? I mean, maybe they've invested in a some sort of municipal project, and you know the project will mature in 6 months, and they've got to sell their portfolio now. That might hurt. You know, I mean, when you build your own portfolio, you don't want to be interrupted and have to sell something, you know, to pay your tuition bill or something, right? And what else happens? They have to pay transaction fees, right? Commissions and all that other stuff when they sell their securities. So that's very costly. Yeah. What else could they do? They could borrow from the Fed, right? Oh, sorry. I wish I had more dexterity. They could borrow from the Fed. There we go. Typically, the banks would go, if they had to borrow from the Fed, they would go to the discount window at the Federal Reserve. Yeah. So years ago, the discount window was really a window at the Federal Reserve Bank. And so the banks would go there. They would send some probably a younger person that works for them over to the Fed, to the discount window, to borrow money to meet their reserve requirement shortfall. Yeah. Nowadays, it's all computerized. But if you ever get a chance to actually go to the Federal Reserve in New York, for example, they have a window, you know, and it's like a part of what you see on the tour, the discount window. Anyway, to borrow from the Fed still costs money, right? So you got to pay the interest on the money. Yeah. So you don't really want to do that. So go on. They have one more option. They could call in their loans. Well, this is the worst option, isn't it? So they had loans of 90 million. They called in 9 million to get the reserves. So reduction of loans is the most costly way of acquiring reserves. Calling in loans antagonizes customers. Can you imagine if, Community Bank called up Dresser Rand and said, hey, you know that $50 million credit line that we've extended to you? We're not going to do it anymore. That would piss them off something fierce, wouldn't it? Or what if they said to the homeowners, people who just got married and they bought a house in Allegheny, and the bank called them up and said, hey, we need the money back. Sorry, right? How pissed off would you be? So antagonizing customers is really pretty much an understatement. All right. So that's the worst idea. So we got 4 ideas, right? Borrow the money. That's what most of them would do. Sell some securities. Well, that's not a great idea. Borrow from the Fed through the discount window. That's okay. Or call in loans. That's crazy. Okay. Asset management. We have 3 goals involved in asset management at the bank. Seek the highest possible return on loans and securities. So the bank isn't going to try to make loans at lower rates, are they? They want to make the most money they can make. They're in business, right? So they're going to make loans to, I'm trying to think of an example. Do you think Community Bank would rather go to Dresser Rand or, Bike and Burrito in Ellicottville? Who's going to pay more money? Dresser Rand, right? The bank is going to send their most polished, best dressed junior executive over to Dresser Rand, and that dude is going to say, hey, can I interest you in a $50 million credit line? Right? They're not going to go to a rinky-dink little business, and they want to get the best at the return on their money that they can. All right. Reduce risk. So they're not going to make loans to risky people if they can help it. Yeah. They want to make sure that if they're giving you money, you have a very good credit score. And the way to get a good credit score is to pay your bills on time, right? And have adequate liquidity. So they have enough liquidity so that if I did go to the bank and say, hey, I want $10 million back so I could buy this yacht, they would be able to manage it. They have 4 tools of doing asset management. Find borrowers who pay high interest rate and have a low possibility of default. So they target business like Dresser Rand over and above, upcycle or something. Purchase security with high returns and low risk. They're going to have a very good investments desk, a desk at the bank where, a team of a half a dozen analysts will work and determine how they should invest their money, the bank's money. What kind of investments should they get into? They're going to lower their risk by diversifying. This is number 4. So they must have investments spread across multiple different asset classes, right? And balance the need for liquidity against increased returns from less liquid assets. So this is important. And this is going to be sort of the crux of what we're going to talk about next. This balancing this asset management and liquidity need. So liquidity management, liability management, recent phenomenon due to the money center banks. So the banking industry has changed considerably. It used to be that they did not pay interest on checking accounts, right? They did not want, the government did not want to see competition between Community Bank and Five Star Bank, for example. They don't want them to compete. Why not? Why might they have in the past not wanted banks to be competitors?
Would it be because of like loans? If they're competing, then it I don't know, like I don't like you know what I mean? It would like mess up the loan system.
Yeah, it could be loans. It could be that the bank, in an effort to make more money, is willing to loan money to a more risky party, which sets up the banking industry to take a big hit. So you're mostly right, Caitlin. What I was looking for was they don't want to, they didn't want banks to compete because they did not want the banks taking excess risk. Yeah, they didn't want to set up the industry itself to be prone to a failure. They want the banking system to work. So we say money centers are big financial centers like New York or London or Singapore this created the 24-hour market, right? And overnight loan markets and new financial instruments and all this stuff came with this sort of deregulation of the banking industry. So they allowed them somewhat to be more flexible. And this gave the need arose for liability management within the banking industry. Capital adequacy. So bank capital helps to prevent the bank failure, right? We talked about this. If somebody goes in and withdraws $10 million and the bank can't find the money to make up their shortfall. Capital affects return for the owners. This is the equity holders of the bank, right? The people who own the bank, the capital portion of the balance sheet. And then regulatory requirements help capital adequacy management. Capital adequacy is being able to give out the money that people come and ask for when, they have their money deposited at the bank and they want it back. So how bank capital prevents a bank failure? Exactly like this, right? Suppose we have high capital bank and a low capital bank. High capital bank has $10 million in reserves, 90 million on deposits. They have 90 million in loans and $10 million in capital. The low capital bank has $10 million in reserves, 96 million on deposits, 90 million, and only $4 million in owner's equity or capital, right? So suppose they have a $5 million loan go bad. Yeah. Say they loaned $5 million to somebody and that somebody went belly up. So the high capital bank then only has 85 million in loans and $5 million left of their bank capital. The low capital bank has, again, 85 million in loans, but now look at, they're out of bed. They're going to go out of business. They've got negative capital. That's against the rules. Yeah. So they have a real problem by not having sufficient capital adequacy management. Very important. Now, this is going to be the last thing I'll talk about today. How the amount of bank capital affects return to equity. Return on assets, you'll remember this from corporate finance, right? Return on assets is your net profit over assets. Return on equity is your net profit over equity. The relationship between return on assets and return on equity is expressed by the equity multiplier, right? So the equity multiplier is assets over equity. So we have return on equity, which is profit over equity, is equal to return on assets, which is profit over assets, times the equity multiplier, which is assets times equity capital. So for example, let me just look at the next slide. For example, let's look at this equity multiplier for the previous low capital bank. They have 100 million in assets and 4 million in capital. This is an equity multiplier of 25. The high capital has 100 million in assets and 10 million in capital. That's an equity multiplier of 10. So we have an equity multiplier of 25 and an equity multiplier of 10, right? So the equity multiplier, if the return on assets was 1% for both of them, the return on equity for the low capital bank would be 1% times 25, or 25% return on equity. And for the high capital bank, it would be 1% return on assets times 10%, or a return on equity of 10%. So we've got a return on equity of 25% and a return on equity of 10%. Which would you rather invest in?
The 25%.
We all want to make 25%. Thank you, Jake. We all want to make the 25%. We all want to go with our portfolio and say, hey, I got to invest in the financial sector. Look at this. Joe Schmo's bank is returning 25% on equity. Give me some of that. Sign me up. Right? How exciting is that? You can go home and tell your significant other that you just bought some investments that's returning 25% on equity. How styling would you be? Except that next month, Low Capital Bank has a $10 million withdrawal and the capital is negative and they close. Then your significant other is fairly pissed off because your nest egg is shot, right? So you see the trade-off here. We all want the 25% return on equity, but we all want our money we all want to still have our money next month, right? That's the big deal. That's a real big deal. Yeah? And that's this. We have a trade-off between safety and return to equity. So the owners of the bank, they want their money to be safe, but it's costly because the higher the capital, the lower the return on equity. It depends on you as a manager of the bank to make the choice. how to invest or keep your money. Do you have more bank capital or do you invest it better? It depends on how smart you are, what kind of investments you choose, what the economy looks like. Yeah, all those things depend on what that trade-off is. And it's your job when you graduate to go and make those kinds of decisions and say, geez, we shouldn't do this investment. We should hang on and keep our capital in-house, right? Or, hey, boss, you know, the economy's looking strong. I think everything will be cool. Let's go into this investment. All right? That's the important thing. And that's a good place to stop today. When we come back on Wednesday, we're going to start talking about credit risk. So we start with slide 26 on Wednesday. And your case studies are due today, right? And I put a thing up on Moodle. I think I did anyway. I think I figured out how to do it. And so you can Dropbox it on Moodle. Don't email me. I get like hundreds of emails. It's crazy. Okay. Thanks, everybody. Have a good night.
You have a good one.
Thank you.
Thank you.
Thank you.
Thank you.